Good morning, everyone, and welcome back to OETV. We hope you enjoyed your weekend and hopefully enjoyed an exciting World Cup. That was an incredible game. Congratulations to Argentina. That might be the most enjoyable game of soccer I've ever watched. And also, there was the biggest comeback in NFL history on Saturday by the Vikings. But let's jump into what we're here for. Look at the week ahead, and we welcome back Brendan McCarty for the last time for 2022. How are you, Brendan?
I'm great. Ready to go today.
Right. So we're going to jump into this. The Fed seems to have confused the market, and with confusion comes selling. Over the weekend, Barron's preview of 2023 stock market included a warning that selling pressure could continue if the Fed's interest rate hikes push the economy into a recession. Time will tell where the market will end up in 2022. But what is your crystal ball saying for 2023? Brendan, are there any countries, sectors, or stocks that we should be looking at?
So the outlooks for the past few years have been pretty straightforward for us, if that's possible, I suppose. We have this little model that sort of gives us correlations and whatnot, and the indicators are pretty straightforward. This year, there's been drift to them, which is kind of strange. It's as if the market sees 1 year and then all of a sudden gets repriced to next year. This has been creating cloudiness in our indicators for the first time in these outlooks. For example, two of the indicators show that this is next year will be like 2003, 2009, which is, I think, what you're hearing across the street, where we have a low to start the year in March, somewhere in that area, and then we rally into end of the year. It scares me when I agree with when the street and I agree. It shouldn't be that clear, so to speak. But there's another one that also shows a sizable rally coming off the lows and off some May lows as well. One that we've been looking at, though, is a little bit more interesting, is 2007 into 2008. Essentially, the outlook isn't, I don't think it's a correlation you can use anymore going forward. I think the Fed is too much of a variable still, in that if they want to get rid of inflation, and I sound like a very broken record here. Or can you a very broken record? It's either broken or not. But anyway, to stop this inflation problem, the rate hikes aren't going to do it. You need to take the money out of the system. Take the money out of the system. If they're emboldened to take inflation out, and that's debatable, I think, based on their actions the last few months, they will suck the money out of the system, which puts more downward pressure on assets, just like it did this past year. At the same time, we saw a dollar peak, 3 months ago? And we had a dollar peak in 02 into 03. So here we go, back to 03 again. One of the biggest things for 03 was a global rally. And we have seen outperformance by the EM and the developed nations against the US. So for us, the starting point for next year is the global markets. We think that's where let me back it up a little bit. I guess if you believe the Fed is going to be dovish, and I don't think they have the will to really suck the money out of the system, and by the time they realize it, it will be past a year. But if they keep money flat, that's going to impact the dollar negatively. So that will help the EM and develop global markets relative to the U.S. markets. So I think that's where you want to be for 2023. I think that's where the gains will be. DAX and the CAC 40 have performed well. The Hang Seng has really rebounded strong. The Shanghai Comp, kind of tough, but not giving up the gains, so it's holding in. The only outlier to this is, if we were to look at this as a fork in the road, we would say, all right, if we believe this is 03 because the Fed are going to be dovish, great. If the Fed decide they're going to really get aggressive on inflation and go after the money supply, like they should be, this sort of changes the scenarios dramatically. It will push a stronger dollar. It might influence overseas policies to some extent, and it will change the outlook and probably lead to another down year in stocks. So I guess it all keys on the Fed. Do you believe they're going to be hawkish? They're going to be aggressive or not with money? And based on the last month and a half, they haven't been. So what's to say they will be next year either? So we're sort of leading to the 03 outlook, even though the street all agrees on this sort of thing. But you're seeing rallies in other markets like global, EM. Even Brazil woke up a little bit after its troubles lately. It's just better performance overseas. I think that's where your gains will be for next year.
It's interesting. I was actually reading something from one of the Nucleus 195 providers, and looking back at the data, when there's a double-digit fall in the market in a year. On average, the market the next year is up 18%. And this is obviously talking about the US. So, listen, that doesn't mean, as we know as industry veterans, if you would, that doesn't guarantee any performance of your past performance. I still think we have a decent rally next year, but that's just my side of it. But I still think we've got a difficult first quarter to look at.
That seems to be a prevailing wisdom, but like by many. That's what kind of scares me. It's like the analysts, the analysts all chase, and they all have an opinion and we all agree with them. And then all of a sudden we all look at each other like, oh crap, we're all wrong. I think the Fed is too much of a variable, and I think that's why it's causing a drift in our models. I think the markets are not sure. And I think we could have a rally. The statistics always, the markets generally rally all the time, it seems, over years. There's only bear markets for like 2 years at a time, right? So I would just say that I don't think next year is going to be as straightforward as many believe.
All right, let's see how we go in 2023. But now that it is the week before Christmas, you do not expect a big earnings week. But lo and behold, there are some big names reporting that you can see on the Earnings Whispers image here. Brendan, let's dig into some of the bigger names that are reporting this week by starting with Nike on Tuesday after the close. Brendan, it's no secret that I've been wary of the consumer space all year. And with Nike's share price down 36% year to date, maybe I was on the right track. But Brendan, there has been a nice bounce off of its lows back in the $82 range. Options are pricing in an 8% swing after the earnings, but mixed opinions from the broking community. Citi thinks that they have sales and margin momentum, and UBS thinks that there could be a full year 23 guidance rise, while Evercore has concerns over excess apparel. Brendan, we have looked at Nike a few times this year. What do you think we can see from these numbers?
So heading into these earnings, I think I mentioned this a couple of weeks ago. Cyclicals have had a second quarter in a row of better performance in terms of its earnings performance. Nike's very much cyclical, if you will, right? But heading into these earnings, Nike's chart is kind of interesting. It correlates highly with the S&P. So it's selling lately. Actually correlates with the Dow. It's in the Dow, but whatever. It correlates highly with the S&P. So it sold off the past few weeks. But it also faced the biggest weekly selling of the year last week outside of the two market lows. So if you take away the market lows, and yesterday wasn't really, this past week wasn't a market low, if you will. It was just a big seller. Nike faced the biggest selling of the year. So investors are clearly worried going into this number based on the selling, I think. But analysts are all singing the same tune. I mean, you just mentioned it yourself, but analysts are singing the same tune. They're all saying apparel makers have excess inventory. It's going to impact margins. Well, if you're selling 11% more goods than last year with higher prices, does that make up for the loss you're going to face on existing inventory? I think that's Nike's situation. So Lululemon came out after Black Friday and said it was the best Black Friday they ever had, I think. And they're not selling. They're not having inventory issues because they keep clearing their inventory. I think Nike is not quite Lulu, but I believe that they are not having the inventory issues that a lot of players are having. They do more direct to consumer. They can see their consumer more directly in terms of behaviors. They're not less so if they sell through these third parties. They're also expanding themes in stores. So like World of Flight is launching in Milan. The question with that is it's only launching in Milan. Why is it not launching anywhere? Which this is why I say it's not Lulu. They're not. If it was Lulu, I would guess they would be launching in a bunch of new ones. They do have new themes though, like Nike Rise. It's more a gender agnostic retail, I guess. And the broader direct-to-consumer strategy is doing better. I mean, they're bypassing the weaker sales and getting stronger sales, which increases profit margins. They're not going to going back to Lulu. They're not going to beat Lulu's numbers. They're not going to be the same behavior, but they still a brand. I will say though, the story is not going to turn a dime. I think it's still sluggish overall. I think the stock over the long term still points lower as the breadth is just not enough to send it higher. Investors really aren't buying into it yet. So I would guess that last week's turn might be a resumption of the downtrend. So this earnings report probably won't be earth-shatteringly strong. I don't think it'll be terrible either. So I think it'll be middle of the road, not enough to reverse the trend.
It's funny. I I think I haven't been shy on Lulu. I just don't like Lulu. And obviously their last update, like it's pulled back. I was just looking at the chart on my phone just then, like how much is pulled back from the highs, and it actually looks like it's a double top there. But I like Nike. This whole consumer space, I just don't like it. I still don't like it. Everyone's watching every penny they're spending right now.
Yeah, but the people that have money are still spending it on the brands. And
Yeah.
there's still a section of people out there that are like they're running the savings down. And there's a lot of Nike realized that their biggest consumer is not the people that buy the stuff through Marshalls and TJ Maxx on the secondhand side. They're buying it directly through them. I think that's why they're doing better. I mean, it's like the department stores are probably not going to do well this quarter because that's a broader swath of people. Whereas the brands will probably do better because that's the people with money are running to them, I think.
Yeah. Well, it's funny. Now I move on to Fedex. I'm like, there's a lot of negative stories we're doing on this one for our last show for the year. But so Fedex reports on Tuesday after the close. And remember that sell-off in September when they warned of a drop off in demand in the US and Asia? Like the whole market just panicked. That not only saw their share price tank, but obviously the big impact on the market. They started cost cutting and high shipping rates. So we'll see if those have had any impact on these earnings. Do you think they've righted the ship, Brendan, or should I say righted the trucks and planes?
It makes me laugh. It's funny. The story about FedEx is not what they're doing, it's how they're doing it. It's operational at this point. They're in cost cut savings mode. Earnings are expected to be lower, sizably so. They're doing another reorganization. I don't know if these come every 6 months or 1 year or every time there's a problem, there's a reorganization. The stock itself is in a long-term downtrend. It hit 180 and looks like it's turning lower again. So I think the bounce from 150 is sort of over. I think the story was, all right, it can't get much worse, but they're still earning $2.40 a quarter, which is $10 a year, $10 roughly a year, which is about an 18 PE, which is where the market sits. So the stock is probably sitting at where the market, its fair value is, but it's probably growing less than the market. I would just say that with sales decelerating and they're in operational mode, everybody's going to be focusing on what cost cuts worked, where are they going forward. I found it interesting. We talked about a company that split off its brokerage for trucking about 3 or 4 weeks ago, and I can't remember who it was. But apparently trucking is seeing higher margins, and I didn't realize this. And it probably has a lot to do with gasoline prices coming in. They expect an upside beat on the trucking side. So that might provide, like I think Bloomberg is like $2.40 or somewhere like that. There might be a possible beat with the trucking side because gasoline's coming down, so your margins are better. I don't know if people care. I think they ultimately want to see, all right, we're going to operate better. This is a story that's quarters away, in my opinion. They'll say today, all right, we're operating better, or whatever they report. Tuesday, when they report, they'll say, all right, we're operating better. Okay, come back to us in 3 months and we'll see where we are. The story, I don't think like a shipping story is going to be like, oh, we ship more goods. I don't think that's going to be the big deal. I think it's all about how they're going to fix their model again going forward.
I only just really thought about this now. Like they've already come out a couple of times this year and said things that have panicked the market, panic with air quotes, but I wonder if they're going to come out with anything again, which is going to panic the market.
The stock turned off at 180. So investors there are a little concerned. I mean, I'm not sure if that is a story that's being driven by the market or them. I mean, it's like who keeps missing? Target. Target keeps missing because they can't seem to work this environment. Nvidia is another one, keeps missing because they can't seem to work in this environment. FedEx seems to be another. But their big inflation part is, it's wages too. But the gasoline side is coming up. So I don't know if it can get much worse for them. I guess it could. But people already know the consumer's a little troubled this quarter. So I think if they say that the consumer's not spending, that's kind of expected in a way. I think that's the baseline. The consumer's not expected to be strong at certain areas. So if FedEx says they're strong somewhere, that's the upside surprise. If they say they're weak, we already knew that, so to speak.
All right, let's take a look at General Mills, and they report on Tuesday before the open as well. And they're a huge success story this year, with their share price up 26% year to date. Two challenges remain in front of them, though: inflation impact and continued supply chain disruption. Do you think that rears its head in these earnings release, Brendan?
So GIS and others have benefited from the inflation story. We've been talking about them for almost 2 years now, I think. Yeah. I think the reckoning for this group, where they raise prices too much and demand doesn't meet it, and then they're stuck with inflation. They're going to have their own inventory issues that puts deflationary pressure on their prices. I think it's coming in the next 2 quarters. I don't think it's coming now. So I think the story right now will still remain strong, where they're raising prices and people are meeting their demand. I guess they're in the right business. I mean, people still have to buy food. There's tons of story. You're seeing stores like, I was in 2 groups of grocery stores in the last 48 hours. One of the stores, the just-in-time person is dropping prices like crazy. The ones who contract out further are keeping their prices sky high. It seems people are accepting them on both ends. So General Mills is probably going to come in probably slightly better, if anything. The outlook for commodities is probably going to be higher. Like we talked about an 03 outlook, one of those other variables that is commodities. They did well from 02 to 2011. Weak dollar will give commodities an upside pressure. If prices are going to rise and GIS continues to push it through, maybe they clip on a little bit there. That demand gives them even better margins because they're just pushing it through. I've always wondered if these deflationary pressures, these high prices first, start creating a deflationary pressure on our waistlines in America. We always eat so much that I wonder if prices get so high for food, will people eat less? And then that's a little side theory. I'll throw that out for another time. Anyway, the stock, China's been a rocket ship. Breath has not followed of late. So the investors are sort of backing off the name. It looks like a little bit, even as it climbs. I'm wondering if my question about the reckoning is going to come into play sooner than they believe. The market's slightly pricing it in. It's not taking the stock down. But I think the future story will be where that demand drops off against high prices. I mean, there's a point where you can't raise your price anymore, and people just won't accept it. They don't have to keep eating General Mills food. They can go elsewhere. So I think that's coming. I just don't know when. So they'll have a great quarter. It's that outlook that's key. So if they don't say anything about it, stock will go up another quarter, and then when they finally say it, stock will get creamed.
All right, let's move on to Micron. And they report on Wednesday after the bell, and they're having a rough 2022 with their shares down 44%. And there aren't many people talking positively about the chipmaker space. Last week, Goldman Sachs downgraded Western Digital, and that impacted the whole sector. Goldman says multiple sources have been telling them that flash memory chip suppliers are offering below cash cost prices in an attempt to work down inventories amid a macroeconomic backdrop. Brendan, is there any hope for Micron from these earnings?
So it's funny, back in the early 2000s, when there was such a glut of semiconductor chips, NAND and DRAM prices were all the focus. I had deja vu. Everybody's talking about these two things again because the prices are sinking. Ugly is definitely being priced into Micron. There's a general belief out there that the industry simply has too many chips. That's driving the prices lower. I was in Best Buy this weekend. There was a lot of people buying technology stuff. I wonder if this might be, I don't know. I may have just been there at the wrong time and it was just a long line. But I wonder if this glut is being overly focused on. And I wonder, I'm not an expert in this business by any stretch, but I'm just curious. I don't know if lines at Best Buy are not good enough to unwind a chip shortage. There's clearly too many chips. Based on the falling prices, falling demand, if you will, what's falling further more quickly? I don't know. Probably the prices. That's not good for the stock going forward. The stock's trading pretty ugly already. It's probably heading to 50. Nobody sees any good news coming. Tough business in the moment. I would just say that if they have any surprise whatsoever to their earnings report, it's not being mentioned by anybody. So that would probably help the stock stabilize above 50. But it's just not a good story. It's continuing to get worse heading into year end. I'd love to see what happens after the turn. I wonder if everybody's like locked up the books for the year. Nobody's buying anything because it's December 19th, 20th. Where are we? 20th?
Yeah, 19th.
19th. Okay, sorry. Time flies. So I would just say that their outlook could be interesting in that they might say price is still falling, but maybe they expect a January bounce in terms of demand. I don't know. Tough to say. I would just say the chart looks ugly. It's probably heading lower. Investors think it's going to be an ugly quarter, and that's pretty much it.
All right, so let's move into love it, like it, leave it. But before we jump into the stocks, let's see how it's performed this year. I want to point out to the viewers that Brendan doesn't choose these names. I usually choose these names on a Sunday in front of whatever sports on the TV. It could be earnings related or events that are happening in the upcoming week. Sometimes they're even themes like Thanksgiving or July 4th or Christmas. So they're not cherry picked by Brendan, and it all comes down to Brendan's analysis of the charts. Brendan, I've given you some doozies this year, and I always love to hear your analysis. For the viewers, can you break down the performance of love it, like it, leave it, and explain the chart that we have up here?
Sure. So what we did, we started with, we had our names. We started officially in late April, maybe. I went back in time and created data from January 1st onward, making random picks with a dice roll, believe it or not, to get me some beginning of the year data. Not to say that you made the picks, but made your sample with a dice roll. But that's how I created data to start the year. You can see that you really don't see the orange line is the 3L100. So the 3L100 is the 6 picks we make each week. It's 100% of the picks in a given week. We buy them. We would buy them on the open today if we made those picks this morning at 9:30, and we close them at 4:30 on Friday, 4 o'clock on Friday. So that portfolio goes long and closes. It enters the 6 names, and then it closes them all out at the end of the week. That's the orange line. You can see that it's had a massive as the markets really started to sink down in the summer following the bounce. You saw the earnings story really flip. You saw it was largely driven by short positions that really pushed us higher. You can see how the orange went higher and the blue and the yellow drifted lower. The blue and the yellow are the S&P and the SPY and the QQQ. As things have come in and as the equity markets have stabilized, you can see that it's become more of a broad-based advance that's working against the 100 picks. Now, the other 2 lines, we create a 3L50, which is 50% of the picks from this week and 50% of the picks from last week. You can see that as orange has come in, gray has sort of held its own. Blue has kind of moved slightly higher, actually, closing the gap. It's interesting in that this implies that essentially trends are lasting more than a week now, or they're taking longer than a week to play out. That's why the blue is closing the gap on the orange. The gray one is a fun one we put together. It's based on all this data. It's called the 3L market. It either goes long or short the SPY and the Qs each week. You can see it's been trading in line for the last few months in terms of with the 3L50. So long story short, we just tried to create a mix of stocks. It's the simplest little thing that, like, Scott makes the sample. I look at the charts. If something is down more than 10% in a week, we take it out of the 50 portfolio. If it's down, we have a 20% hard stop. So if we're off by 20% or more, the price would be closed at that level. A couple of weeks ago was a real rocky week. You can see it in the 3L100. That thing dived one week. I think it was down 12%. Because we had, at one point, I think our picks on the short side were all up 15%. Like 4 picks were all up 15% for 2 days. And 2 picks were down 20% on the long side. And then it all reversed. It was the craziest week ever. But you can see overall the picks have outperformed. They've done well. It's just random momentum. But if the biggest takeaway from the chart is momentum seems to be unwinding as we head into the year end. And trends are taking a little bit longer to play out, which is why you see the blue and the orange lines sort of coming together. But it's a fun exercise. I love doing it each week. It's based on methods that I employed when I first came into the business. So we're not really inventing the wheel too much here. It might be the simplest portfolio strategy ever. But we continue to do it. I love doing it, and we'll continue hammering away next year.
No, well, thanks. It's the reason I wanted to bring it up because we had a viewer last week throwing some questions on one of our social media platforms and like saying, "Well, Disney, you're out of your mind because you said sell Disney last week," and we had a bit of back and forth. And I said, "Listen, this is not for a long-term view. And he was talking about Avatar: The Way of Water and how that's going to be a catalyst for Disney." I said, and I actually said to him, "I said, listen, this is going to be all about the Fed this week, and it'll all be about Way of Water." Now, obviously, he closed out the end of the week, but you did well. Disney was down $5 last week. So,
yeah, Avatar didn't do well, surprisingly. That's an expensive movie. I didn't realize it's 150 million to produce that thing. Holy crap!
They've got to make $2 billion for it to really make money. So
really, oh my god,
that's even what James Cameron, the director, that's what he said. So,
jeez.
And I think there's, I can't remember what the layout, what film setting he recommends everyone to watch it in, but there's only 187 theaters in the US that have that capability, and it's very
limited sales.
Yeah, and it's a very difficult sell now because there's a lot less. And I actually said this to him. I said there's a lot less theaters now than there was the original Avatar, and there's a lot more ways to watch it afterwards. So, but it was a good call on Disney as well. I'm saying from last week, but. Yeah. Let's jump into this week's Love It, Like It, Leave It. And I have to admit, I was going to get a Santa hat for this because it is a Christmas theme, but I went to CVS and they didn't have any Santa hats left. So everyone's obviously fired up for Christmas. But we're going to pick on some stocks that obviously have the Christmas theme to them. And where is Santa going to be doing his shopping this Christmas? So you all ready, Brendan?
Let's roll.
All right. First one is Hasbro, HAS.
Side story there. The toy makers are running into inventory issues, according to this DTC consumer letter. Interesting point. Anyway, I would leave it. Weak picture as it failed on 62.5. Looks like it wants to go to test 55 next. Maybe that's all related to the inventory.
Okay, the next one is Etsy, and that's a simple symbol, ETSY.
What a player. This stock's been rocket ship off the lows for the last several years. I like it. Bounced off the 65 week, which is nice. It had some breadth to support it. The breadth's backed off a little bit lately, but I like it. It needs to get away from 137 in short order, though, or the shorts will pounce on it.
Amazon, obviously shipping everyone their presents, the virtual Santa.
Leave it again. I think we've left this thing many times lately. It's kind of funny because I was all over Amazon the last few days. I left it. I'll leave it. Trend is still lower. It looks like 80 is where it wants to go next.
A quick sidebar there. Amazon and Tesla did stock splits this year, and it has not worked out well for either one of them. Next one, the Children's Place, PLCE.
I haven't seen one of these in years. It's been a long time. Leave it. It failed on 38. Looks like it wants to move towards 30 next. I think there's a long-term trend here of malls sort of going away and Children's Place is loaded in them.
Another one I've been bearish on before, Williams-Sonoma, WSM.
Leave it. Chart failed to get over 115, which would have set up a nice climb to 130. Now it looks like it's heading to low 100s. Interesting how it's weakening around this time of year. It usually does better.
And the last one we're looking at is Electronic Arts, EA.
So I thought this one would do better too, given the Activision's thing is having issues with Microsoft, but it isn't. I'd leave it. Broke support at 126. It rejected the 65 week, which is very ominous in terms of downtrends. Usually if you hit the 65 week and go lower, it argues much lower lows. Right now, it looks like it wants to go to 117.
Great. Well, keep an eye out for later on this week too. We have an interview with Robert Scott. He's breaking down the Activision Microsoft deal as well. So it's going to be very insightful for everyone.
It's a big deal. It's like it's a Activision, like EA was a big player with Xbox. EA Play was tied directly into Xbox's Game Pass, and the Activision thing sort of pushed it out. I think it's going to pass. I don't know what's going to happen to it, but EA was a really big player in there. And if Activision didn't get bought by Microsoft, they thought they might go after EA just to add it to the Game Pass. But EA didn't they lose some rights in soccer and a couple other things? So they're having a little issues lately, but it's an interesting story. It's well worth listening to, I would imagine.
Yeah, you watch this show. I was speaking to Robert last week, and it's some great insights he has, and we're very lucky to have someone come on like that to talk about it. But Brendan, first of all, I want to say thank you so much for this year. It's been very insightful and very enjoyable. Lots of smiles and laughs. I also want to thank everyone in the background as well for this year. Stu Semonite, who's sitting in the background there today. Brendan Bresney, who was doing it at the start of the year as well. You guys are ever so helpful on the Open Exchange team. Brendan, Merry Christmas and have a great holiday period.
You too. Everybody, Merry Christmas and Happy Holidays.
And for everyone else out there, have a great holidays and good luck investing.